Hi everyone, so welcome to the stream today. Really excited for having you as we continue with our discussion towards the November 2024 examination. We are starting with our IFRS masterclass to enable us solve questions, discuss basic principles when it comes to the accounting standards. If you follow the discussion yesterday, we realized that and saw that as per the Chief Examiner's report for the July 2024 examination, financial reporting, we're going to be having about 70% of the issues relating to the accounting standards. And so really understanding the accounting standards and knowing how the principles are, and most importantly, how you see questions, do various treatments will be very important. And so today we are starting the discussion with IAS 16, property, plant, and equipment, and then possibly IAS 2, inventories. And so I'm going to be bringing my screen up quickly, then we get ourselves into the discussion. The assumption then is that it means that you have understood or gone through some of the basic principles of these accounting standards, so that on these live streams, we are just going to be solving questions and then crystallizing the principles as well. So if there are any questions you have, you know what to do already. You put it in the comment section for me or the chat box. I'll be taking your questions as well as we go along in the discussion, trying to solve some questions here. So we go straight up into the discussion and we are looking at our very first question here, and you can take a screenshot of the question certainly. That enables you to make reference later on. So question number one, the requirement is A, account for the revaluation in the current year. B, account for the decrease in value. And then C, account for the revaluation and state a treatment for depreciation from 20x8 onwards. And so the first part of the question is the A, the second part of the question is the B, and the third part of the question is the C. So let's see what we do here. So if you look at it, this question here is about revaluations. And so if you remember, the principles when it comes to revaluation of assets, what is going to be happening generally is that we are going to be comparing the carrying amount of the asset to the revalued amount. And as you remember, or you should know, what happens is that if our carrying value exceeds the revalued amount, that is going to be an impairment or a revaluation loss. Okay, an impairment or a revaluation loss. And for the first time, when we revalue assets like this, please, the RA here is not recoverable amount, it's revalued amount, okay? So the first time when we revalue assets and we get an impairment loss or a revaluation loss like this, it's automatically going to be recognized in the profit or loss account. Okay, so for that first time, we recognize the loss in the profit or loss for the first time. Also, if for the first time we revalue assets and it turns out that, the carrying value is greater than the revalued amount, which means that we are going to be getting a revaluation surplus or revaluation gain. Revaluation surplus or revaluation gain. Again, for the first time, when we revalue an asset for the first time and we get a revaluation surplus, then it will be recognized in the OCI. So this will be recognized in the other comprehensive income. Okay, to be recognized in the other comprehensive income. And so this is the default treatment that we start the discussion with, that when we revalue an asset for the first time and we get a loss, P&L. And so for journal entry purposes, if we want to, it will look like this. So journal entry, we would debit the profit or loss. All right. Then certainly credit the property, plant, and equipment. So that's a journal entry. first time revaluation loss or impairment in the asset. Then if we have a first time revaluation surplus, as I said, we're going to debit the property, plant, and equipment because the value of the asset is going up. And then we credit other comprehensive income, or if you want, revaluation surplus as well in that case. And so that is the default way of revalue assets, or how we treat revaluation of assets. The default way, that's the starting point. All right, that's the starting point. That's the default way of revaluing assets. Now, wanted to see if my audio was good. Now, what happens if we do a first revaluation and then on subsequent measurement, we are now seeing that, oh, the asset is having a different thing? What do we do? And so let's look at that principle as well. Then we can come to our question. So subsequent revaluation. So let's say that on subsequent, so for the first scenario that we had here, that's what we are having. So first year, we revalue, it was a loss. Now in the subsequent year, we revalue and now it's a gain. Oh, okay. So subsequent revaluation gain. What we do is that the gain will be recognized first in the P&L account up to the impairment loss previously recognized. Any excess amount is recognized in the OCI. That's what's happening here. So on that subsequent revaluation, which results into a gain from an asset that was previously suffered, or that had previously suffered an impairment, what is going to be happening is that first, although it is a gain and by default it's supposed to go to OCI, no, it will be going to P&L first. So the gain shall be recognized in the profit or loss up to the impairment loss recognized in the previous year. All right. Then any excess is recognized in the OCI and revaluation surplus. This is the principle. Okay, so what does that mean? Pretty simple journal entry. So you debit profit or loss up to the previous year impairment that we recognized. You credit your PPE. It's a revaluation gain. So we debit PPE rather. And then we're going to credit the profit or loss. Then the excess, which is the balancing figure, is going to be credited to OCI or revaluation surplus. That is the idea about that. So last year, the assets suffered an impairment. This year, we have revalued and it is a gain. That gain doesn't go straight up into the P&L. It will be first recognized in the, that gain doesn't go straight up to the OCI. It will be first recognized in the P&L. The excess amount of it is what will go to OCI and revaluation surplus. Then, in the second scenario, which we said, we revalued the asset the first time and it was a surplus. So on subsequent measurement, if we do the revaluation and it is now a loss, how do we account for it? Pretty simple here. So now we are getting a revaluation loss from an asset that previously had a gain. Just like how we did the first one, you just flip it up. So the loss will be first recognized in the OCI up to the balance on the revaluation surplus. Any excess is what is going to the P&L account. So the loss is recognized in the OCI against the outstanding against the revaluation surplus relating to the asset. Okay, then any excess amount is what will go to P&L. Any excess is taken to profit or loss. So here our journal entry will look like this. You debit first revaluation surplus, as we said, with OCI on the line. So it will go to OCI as a negative. Then you're going to credit PPE because the asset is falling in value. The balancing figure is also going to be debited to profit or loss. That is, if the revaluation loss account doesn't have enough balance to take care of the whole impairment or the revaluation loss that we are getting in the subsequent year. So this is how we deal with revaluations. So it is important we understand how it works for the first time and how it works on the subsequent. So now, having understood this principle, we go to the context of our question and then see what we can do here. So what do we have? Let's see. It says Binki Co. has an item of land carried in its books at £13,000. Carried in its books at £13,000. 2 years ago, a slump in land values led to the company to reduce the carrying amount from £15,000. This was recorded as an expense. There was a surge, or there has been a surge in land prices in the current year. However, the land is now worth £20,000. So let's gather around what the heck is going up here. So Binki Co. So we get first the carrying amount 2 years ago. We were told that 2 years ago it was carried at £15,000. But then they are now carrying it in their books at 13,000. So revalued amount. Also 2 years ago is 13,000. So it means that the land suffered an impairment. Or if you want revaluation loss of £2,000. Stay with me. And they said this was recorded as an expenses. Yeah, because it's right. That's what we just said. That if we revalue the asset for the first time and it results into a loss, what do? We take it to the P&L account. So they've done the right thing, taking that 2,000 to the P&L account. But let's see what's happening now. There has been a surge in land prices in the current year. However, the land is now worth £20,000. The land is now worth £20,000. So the revalued amount currently £20,000. And so the balancing figure means that we'll have a revaluation surplus here of £7,000. Now, how do we account for this £7,000 here? We cannot pick the £7,000 and then boom, throw it into the OCI. Because remember previously, it was having what? An impairment loss. So what will be the journal entry? Our journal entry will look like this. Yes, the asset is going up in value. So we're going to be debiting the land with £7,000, the value that is going up with. But we'll first credit profit or loss with the impairment that was previously recognized, the 2,000. Right? Then the balancing figure is what we will take to revaluation surplus, which will go on the face of the statement of financial position, or OCI, 5,000. This is the answer to the question. This is the answer to the question. So again, principles you apply. Principles you apply. This is very important. You look at the principles, then you apply. Any questions, you put it in the comment section or the chat for me, and then I'll be able to answer the questions for you. So that is the idea about the first part of the question, the principles you apply. And as I keep on telling you this, you have to understand that when it comes to the accounting standards, it is about understanding the principles. It doesn't matter. You don't need to solve 7 billion questions. You need to understand the principles. Then when you read a question, boom, the principle is going to be occurring generally in that regard. Let's look at a second scenario here. In the example given above, assume that the original cost the original cost was £15,000, revalued upward to £20,000 2 years ago, and has now fallen to £13,000. So what do we do? So second scenario, B. So we bring in the initial cost. And that is going to be coming up here of £15,000. Then, what are we told? Revalued upward to £20,000 2 years ago. So let's go. We bring in the revalued amount. 2 years ago. 20,000. So the balancing figure means we will recognize a revaluation surplus of £5,000. Of £5,000. Then they said the value has now fallen to £13,000. So we bring in the revalued amount. Again, this is a land, so we keep it simple. We're going to get what we will calculate depreciation in a moment. So revalued amount in current year, 13,000. So the balancing figure, it's going to be the revaluation surplus, which is 7,000. Sorry, not surplus, revaluation loss, 7,000. So how do we account for this? Now, so again, if you pay attention, It's just a flip side of that, of the same question solved in another, presented in another way, so you can see both parts. So let's look at the journal entry in the current year. We are having a loss of 7,000, so suddenly we are supposed to credit the land account. So we credit the land with a loss of 7,000. But what do we debit? We have to debit the revaluation surplus account with the surplus that we had 2 years ago in respect of this same asset, the land, which is 5,000. Now, since the loss is 7,000, it means we have to write everything off. So we'll debit revaluation loss, revaluation surplus with the 5,000, because that is what is there, so that the balancing figure will be taken to the profit or loss account. So we debit profit or loss with a balancing figure, and that's going to be £2,000. This is what we are talking about. So we revalue asset. Now, there is another level of treatment that we need to understand where there is annual transfer. And I'm going to be illustrating that in a moment. But we could have an annual transfer in that case. And that annual transfer could change the way the values will be. The concept will be the same, but it will just change the way the value to be. Now, this is land. It's not a depreciable asset, so we won't do transfer in respect of it. But if it is building or other forms of assets, then it's a depreciable asset, because one key principle that you need to also understand is that depreciation is calculated on revalued amounts. And so normally what happens is that more depreciation is going to be charged on the asset after it is revalued than we are charging. And so to compensate shareholders for that excess depreciation, we're going to be moving the money from, or the amount from, the revaluation surplus account into retained earnings. And the journal entry for that is to debit the revaluation surplus account and credit the retained earnings, which means that in subsequent periods, the revaluation surplus account will be reducing. And so it doesn't really change our double entry thing. It just tells us the amount of money that is available in the revaluation surplus accounts in subsequent years as we try to work this out. So that's the second scenario there, and that is it about that. Let's look at the final scenario here. It says that Crinkle Co. bought an asset for £10,000 at the beginning of 20x6. Now, for disclaimer purposes, these set of questions are coming in from the corporate reporting and audit and assurance for London School of Business, for the Institute of Chartered Accountants, England and Wales manual. So that's where we are picking these questions from. And we have, a ton of questions here that we're going to be going through throughout in this masterclass. And so that is the source document for some of these questions that we are bringing up from the Institute of Chartered Accountants, England and Wales corporate reporting and audit manual. So Crinkle Co. Let's go there. Crinkle Co. It says, Crinkle Co. bought an asset for £10,000 at the beginning of 20x6. All right. So we bring in the initial cost of the asset at 1st June 20x6, £10,000. Then it had a useful life of 5 years. So it means we are going to be depreciating this one. On 1st January 2018, the asset was revalued to £12,000. Stay with me. So the revaluation is being done at the beginning of 2018. Remember, the year ended for us, it's 20x8. So it means the asset was used in 20x6, was used in 20x7, because the revaluation is being done at the beginning of 20x8. So what do? We have to calculate depreciation. So we less the depreciation for the 2 years. And that is going to be £10,000 over 5 years times 2. So this is depreciation for the 2 years. Because the revaluation was done at the beginning of 20x8, which is in the third year. So what do we have? 10,500, that will be 4,000. And so the carrying amount at 1st Jan 20x8 will be 6,000. The day on which they did the revaluation. Then we bring in the revalued amount. So revalued amount 1st Jan 20x8. We are told it was revalued to £12,000. So what do we have? The balancing figure, it's going to be a revaluation surplus. Which is £6,000. So in the current year ended revaluation surplus, this is the first time, and that will go to OCI as well, other comprehensive income. But let's see. What else did he say? The expected useful life has remained unchanged. The expected useful life has remained unchanged, i.e., 3 years remain. Because if the useful life is 5 years, right? And we've done 2 years, that means we are left with what? 3 more years to go. So now, depreciation for the current year ended, which is 31st December 20x8, will be calculated on the revalued amount. So we bring that in. We less depreciation for the year. And that's going to be the 12,000 over the remaining economic useful life, 3 years. And that's going to give us an amount of 4,000. And so we get £8,000 as the carrying amount at the end of the year. And that's the idea about that. Now, so I'm going to do 2 things. One, I'm going to do the default thing, assuming there is no annual transfer. How would the treatment look like, right? Then we'll look at a transfer. How would the treatment also be like? So, Crinkle Co. Statement of profit or loss and other comprehensive income. And other comprehensive income for the year ended 31st December 20x8, right? We're slashing our currency sign. Please, professional presentation is very, very important. So in the profit or loss, what comes there is the depreciation for the year, which is the £4,000. $4,000. Okay. Now you got to be careful because you don't bring the total depreciation from the time we bought the asset. No. This is another thing that students screw up with. We bring depreciation relating to the current year ended under review. That's what we are interested in. Because the last 2 years depreciation, those have been accounted for already. So we have no problem with them. Sounds good? So we are going to bring just the depreciation for the current year under review. So then we go to the OCI. Other comprehensive income. So in the other comprehensive income, we bring in the revaluation surplus. Because the revaluation was done at the beginning of the current year, we bring the revaluation surplus here. And that is going to give us an amount of whatever the heck, £6,000. And that's it. So that is the extract. Now, this is an extract. So again, we want to let the examiner know that we know what the heck we are doing. So we put extract in brackets. Right? We put extract in brackets. So that's our statement of profit or loss and other comprehensive income. What comes in the position? Pretty simple. So statement of financial position. As at 31st 12, 20x8. Also an extract, is boring, but you got to write them down. So what do we have? We're going to bring in the non-current assets. And the carrying amount, which is the 8,000, that's what's going to come here. $8,000, right? Then we go to equity. And in equity, we're going to bring in the revaluation surplus. And that is going to be how much? Okay, it's even up there, 6,000. So this is the answer to the question in respect of what we have to do. Again, in this one, we are assuming that the entity doesn't make transfers. Okay? So the question then we have to ask ourselves is, okay, how would we present this if the company makes a transfer? Because again, if you remember, I said something that depreciation is calculated on the revalued amount. So when we calculate depreciation on the revalued amount, it means you are charging more depreciation than you're supposed to have charged. So if you follow what is happening here, you realize that in the top here, the depreciation for the 2 years was 4,000 because each year we charge a depreciation of what? 2,000. But after the revaluation, the depreciation for 1 year was 4,000. Now, depreciation is an expense, and so what it means is that the profit is going to reduce. It means shareholders will not have a lot of amounts payable to them as dividend. And so sometimes an entity may elect to transfer the excess depreciation arising from the revaluation surplus from the revaluation surplus account to the retained earnings. Now, our P&L and OCI will still remain the same as it is supposed to be. But what is going to be happening is the carrying amount of the revaluation surplus at the reporting date. The carrying amount. And so I'm going to just duplicate the position to bring in the revaluation surplus situation. The annual transfer situation, rather. So assuming the entity is doing a transfer to compensate the shareholders. So transfer from revaluation surplus to retained earnings. All you would do is that to be able to get the annual transfer, you can just take the revaluation surplus figure divided by the remaining economic useful life. Of the asset. And so if we take that, what was the revaluation surplus we had? We had a surplus of 6,000. The remaining economic useful life at the date of the transfer was 3 years. And so every year we would transfer £2,000. And the double entry for that is to debit the revaluation surplus accounts and credit retained earnings. With the £2,000. So if I come to my position, because we are doing a transfer of 2,000, right? In the position, the revaluation surplus will no longer be 6,000. It will be the 6,000 minus the transfer of 2,000 we are making. So now the current amount is going to be 4,000. Then we did a transfer to the retained earnings, so we can bring in the retained earnings, 2,000. Please note, we are doing the transfer for this current year ended 31st December 20X8 because the revaluation was done at the beginning of the year. If they had done the revaluation at the end of the year, we won't do any transfer for that year. So we only do the transfer in the year of the revaluation if the revaluation is done at the beginning of the year or midway in the year. But if the revaluation is done at the end of the year, we won't think about any transfer issue. Why? Because if a revaluation was done at the end of the year, then you have done the calculation already in respect of the depreciation amount, and that is all in that regard. So that is what we need to understand when it comes to dealing with the annual transfer. Now, this question was quiet, so you don't worry yourself to do the transfer. Does that make sense? The question was quiet. So if the question is quiet, just do your normal thing like we presented. What the heck? Like we presented like this. Take the revaluation surplus to OCI, take it there, and then you go away in that case. No problem on that. But if in the question we are told that a company makes annual transfers, then it will be looking like this. And as I said, you will just have to take the revaluation surplus divided by the remaining economic useful life. But as I said, we will only do this if the revaluation was done at the beginning of the year or within the year. If the revaluation was done at the end of the year, in the current year, no transfer will be done because you didn't calculate depreciation using the revalued amount. I'm emphasizing on this because of the principles that some people butcher. But that is the idea about that for Crinkle Co. I don't know if I got the name right. Yeah, Crinkle Co. And that is the answer to that question. So now from the 31st March 2008, depreciation is going to be calculated using the remaining useful life like we have done here. And that is the answer to the question. Let's see. I don't know. I'm seeing some comments coming up here. Any questions, you put it in the comment section or the chat for me. And I will be able to see them. Okay, so let's see. Prince J, who said hello, said hi. And then, what's today? Say, what about revaluation loss? Revaluation loss about what? Exactly. When you say what about revaluation loss, what do you mean? In what context are you asking? What about revaluation loss? I don't understand. What do you mean by that? So maybe you can give me some ideas about what exactly you are talking about there. Okay. Now, the last thing about revaluations, so in revaluations, you need to know how to recognize the following. 1, a loss. 2, a gain. 3, make transfers. And 4 is the deferred tax implication. Which is where IAS 12 comes to town, income tax. So then, should the treatment be there as what you did? If there is revaluation loss, I don't think you are following. Maybe you are just joining the class and you can watch the playback of the video because we've dealt with revaluation loss and its treatment already. So you can watch the playback when the stream ends because the question you are asking, I don't understand what the heck you're talking about. If it is revaluation loss, the treatment will not be like that. So we've already spoken about how to treat revaluation losses. So after the stream, you can watch the playback of the stream. So I don't have to go back to repeat that same thing in that case. Hi, Nhyira. Love you from India. Okay, Indian. Thanks for joining us on the stream. So let me bring this back. Good. So when it comes to revaluations, we must know how to deal with losses. We must know how to deal with gains. We must know how to deal with transfers and deferred taxes, which is where IAS 12 comes to town. And these are the 4 things we must understand when it comes to dealing with IAS 16, the revaluation part. And I'll come back to the deferred tax implication later on when I walk you through IAS 12, and then we are solving questions about that. We'll bring ourselves back to the IAS 16 and deal with what we have here. So that is the concept of how we deal with revaluation of assets and the way they must be treated. When there is a loss, how do we go about it? When there is a gain, how do we go about it? And most importantly, when there is a transfer also, how do we go about it? So we've touched on the first 3 items. The 4th one, as I said, we're going to be looking at IAS 12, solve some questions about that as well, and then bring back IAS 16 fused with IAS 12 in the deferred tax implication when assets are revalued. So let's look at the next question here, which is going to be IAS 2, inventories. This is the next question. IAS 2, inventory. Let's look at it. It says, calculate the cost attributable to products 1 and 2. Calculate the cost attributable to products 1 and 2. Stay with me carefully on this one. A product line results in 2 outputs, product 1 and product 2. Parts of the production process give rise to indirect costs specifically identified with only one of these products, although other costs are not separately identified. Budgeted information Our budgeted cost information for the most recent month is as follows. So we see the total, we see product one, da 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 da. So let's begin the journey. Do we have a name for the company? Nope. Okay, so just gonna have products, whatever the heck, product one and product two. So product one, product two. Bring in our currency sign here in that case. Then let's start. We see first direct costs. So let's bring them in. Direct costs. How much? 140, 160. So 140,000, 160,000. Stay with me. Next, indirect production overheads. Indirect production overheads. So we are seeing identifiable, so we bring them in. So indirect production overheads. O/H is overheads for me. Don't go and do that in the exam hall. If not, the examiner will come after you. I'm not there. Identifiable. And so how much we got? 37,000, 45,000. Like this. Okay. Next. Other. And the other is 50,000. It's not categorized. So let's continue to read. Then we are given the budgeted units. Product one is 690. Product two is 900. We'll come back to that. Again, if you pay attention, you see that I read, I work. I didn't read the whole question and then ask myself, hey, my God, how can I answer the question? No. You read, you work. That way, you are processing less information at a go. And it helps you to understand and work with that speed and accuracy thing in the exam hall. The entity has a policy which allocates indirect costs which are not specifically identifiable to an individual product by reference to relative selling prices. This results in 60% being allocated to product one, 40% to product two. So that 50,000, it's 60-40. So other 60% against 40%. So the 50,000 pounds multiplied by 60, multiplied by 40%. That's how we're going to be allocating it. Give me a moment. Let me see if I can rearrange my slide a little bit. Yeah, something like that. That's good. So what do we have? 60% of 50,000. Getting 30,000 here. So ultimately, this is going to be 20,000. Sounds good? Then we go. Next. During the month, costs were incurred in line with the budget. Stay with me. Costs were incurred in line with the budget. All right. So it means that to get my total inventory cost, this is what is going to happen. 140, 37, 30, and that's 207 pounds. So that'll be the total inventory cost for product one. Then we go 160, 45, 20. That's 225 pounds. Okay, that's total. But we can get the cost per unit. And so per unit, we have 690 and 900. So let's bring in the budgeted output. — 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. 690 , 900. We divide, okay? So that we can get the inventory cost per unit. What we got? 225 and 23 by 900. Ooh, 250 pounds here. 207 by 690. Ooh, 300 pounds here. All right. So this is the inventory cost per unit as per the budget. Again, they said during the month, costs were incurred in line with the budget. So that's why we know that in the current month, the actual cost they incurred will be this. But let's continue to read. It says, but due to a failure of calibration to a vital part of the process, only 675 units of product B could be taken to inventory. The remainder produced had to be scrapped for zero. Oh. So it means that when it comes to product 1, no problemo, they got all the 690. But when it comes to product 2, something happened. So product 2, the actual they got in inventory was 675. So inventory cost is going to be the 250 times 675. And that gives us what? 168,750. So this will be the cost of inventory for the product 2. Now, they said the remainder was scrapped for zero proceeds. It means that will be expense in the P&L account. So expense in profit or loss is going to be 250 because the cost of the inventory is still 250 times now. Product 2, we're supposed to get 900, but we got only 670. So how many units did we lose? 675. We lost 225. So what will go to the P&L account, 225 by 250, will be 56,250 pounds. This is the answer to the question. This is the answer to the question. Any questions? Any questions? So you see that it's an inventory question coming in from, an angle that you need to understand what is supposed to go to P&L and what is going to go to the statement of financial position as the inventory cost. As the inventory cost. All right. Seeing some comments coming in. Let's see if we can take them. Bros said, sir, your YouTube videos really helped me with my FR September attempt. Okay, that's great. All the best. Give me a second. Give me a sec. So he said, "Sir, your YouTube videos really helped me for the September." Okay, so all the best in that. Thank you for the great lectures. Always a pleasure. Doreen Nyerinda said, "I'm enjoying. Thanks." Okay, keep enjoying. All right, so let's go. Ooh. This is not a feed I'm looking for. Let me bring my feedback. So that is the idea about inventories as well, IAS 2 inventories. So these are the two questions that I wanted to bring to your notice today. God willing, tomorrow I'm going to be coming back on the stream, and then we'll be looking at some other questions in respect of still IAS 16 and IAS 40, looking at the principles. And so got a couple of questions here. We'll get into impairments as well later on. And so I have the questions here. As much as we can, we're going to be jumping on the stream and then providing you with some ideas in respect of what you are supposed to do in that particular case. So that's it about that. And going to be wrapping up around here today. And God willing, next week, not next week, God willing, tomorrow, we'll be coming on the stream to continue with the discussion. Remember to subscribe and stay connected. Click the bell notification icon so that even if you don't get the messages that we send out for our live streams, YouTube will definitely send you the notification so that you'll be able to join the class or whatever. By 4:30 p.m., you can hop on the call or hop on the stream, and then you'll be able to be part of the lecture. So this is what the standards, is all about. So knowing the principles, applying the principles. Knowing the principles, applying the principles. Your ability to be able to do this over and over again crystallizes the principles and position you to ultimately be able to pass the examination. So that's it about that. And I'll see you same time tomorrow as we continue with our discussion.